When we talk about war, we tend to focus on the visible consequences, loss, displacement, destruction, and rightly so. But if you step back and look at the system as a whole, you begin to see something more uncomfortable, something that challenges our assumptions about how the global economy actually works. Because war doesn't just destroy, it redistributes. It reallocates capital, redirects production, and reshapes priorities at both the national and global level. And within that redistribution, there are actors who, whether intentionally or not, find themselves in a position of growth. One of the clearest examples of this is the defense industry. Now, this is not a story about good or bad. It's a story about incentives. In a world shaped by geopolitical risk, defense becomes not just a policy choice, but a necessity. Governments are responsible for protecting their sovereignty, securing their borders, and maintaining strategic balance. And when conflict escalates, or even when the perception of conflict increases, those responsibilities become more urgent. As a result, defense spending tends to rise. And when defense spending rises, entire sectors of the economy experience a surge in demand. Companies that produce military equipment, advanced weapon systems, surveillance technology, and logistics infrastructure suddenly find themselves at the center of national priorities. What Ian Bremmer often points out is that in a geopolitical crisis, governments don't operate like markets. They operate like systems of risk management. And when risk increases, spending shifts accordingly. That shift is rarely linear. It accelerates quickly, often in response to a perceived threat. And once that spending begins, it creates momentum. Because defense procurement is not a one-time transaction. It is a long-term process. Contracts are extended. Supply chains are established. Maintenance, upgrades, and training programs are built into the system. What begins as a response to conflict often evolves into a sustained investment cycle. And that cycle has ripple effects. Defense industries are deeply interconnected with other sectors, technology, manufacturing, engineering, logistics. So when defense spending increases, it doesn't just benefit a single company or industry. It activates a broader economic ecosystem. This includes advanced materials, artificial intelligence, cybersecurity, aerospace engineering, and communications technology. Many of the innovations we associate with civilian life today, GPS, the internet, even certain medical technologies, have roots in defense research. So in times of conflict, innovation often accelerates. But this raises a deeper question. Why does this happen so consistently? Part of the answer lies in how governments prioritize risk. In stable times, budgets are often distributed across a wide range of domestic priorities: education, healthcare, infrastructure, social programs. But when geopolitical tensions rise, national security moves to the top of the hierarchy. And when that happens, funding follows. This doesn't mean other sectors disappear, but it does mean that defense becomes a focal point for investment, attention, and innovation. And companies that are positioned within that ecosystem benefit from that shift. However, it's important to approach this with nuance, because these outcomes are not simply the result of conflict. They are the result of a system responding to uncertainty. In a world where threats are real and unpredictable, governments must prepare, and preparation requires resources. The psychological dimension of this is also important. Conflict changes perception. It alters how leaders think about risk, how investors allocate capital, and how societies define security. The threshold for what is considered necessary changes. And when that threshold changes, so does spending behavior. There is a collective shift in mindset, from optimization to resilience, from efficiency to preparedness, and from cost minimization to risk mitigation. That shift is what drives the expansion of defense industries during times of conflict. But there is another layer to this that is often overlooked. Defense industries operate within a global system. This means that while one country may be increasing its spending, others are responding in kind. This creates a kind of strategic equilibrium, a balance of power where no single actor can afford to fall too far behind. This dynamic leads to what we might call a competitive escalation. Countries invest not just to respond to current threats, but to anticipate future ones. And that anticipation fuels continued investment, even in the absence of active conflict. So the impact of war on defense industries is not just reactive, it is forward-looking. It shapes long-term strategy. It influences technological development. And it reinforces the role of defense as a central pillar of national policy. But perhaps the most important insight here is this: these outcomes are not accidental. They are systemic. They emerge from the structure of the global order itself, a system in which security, risk, and power are deeply interconnected. And within that system, there are actors who are positioned to respond quickly, effectively, and strategically. Those actors, whether they are companies, governments, or entire sectors, often find themselves in a position of advantage, not because they sought conflict, but because they are prepared for it. And that distinction matters because it reminds us that in a world shaped by uncertainty, preparedness is not just a strategy, it is a form of survival. And in some cases, it is also a source of growth. So when we look at the hidden economic winners of war, we are not just identifying beneficiaries. We are observing how systems respond under pressure and how even in the most challenging circumstances, the logic of incentives continues to operate because in the end, war disrupts the world, but it does not suspend the rules that govern it. It reveals them. And those who understand those rules, those who are positioned to operate within them, are the ones who often emerge stronger on the other side. When we talk about energy in times of conflict, we're really talking about leverage. Who has it, who loses it, and who gains it as the system adjusts. Because in a war, energy is not just fuel. It becomes a strategic asset, a bargaining chip, and sometimes a source of power that can reshape global relationships. And that's where we begin to see the hidden economic winners emerge. In moments of geopolitical instability, especially when conflict touches energy-rich regions, global supply chains don't just weaken. They reorganize, they search for stability, they look for reliability. And in that search, demand shifts toward those who can provide consistent, secure supply. This is where energy producers outside the conflict zone often gain an unexpected advantage. Countries that can maintain or increase production during periods of instability suddenly become more valuable to the global system, not just as suppliers, but as stabilizers. Their role changes from commercial participants to strategic partners, because in a volatile environment, reliability becomes more important than cost. Markets begin to prioritize security of supply over price optimization. And that shift changes everything. Suddenly, countries that were previously just one of many suppliers find themselves in a position of increased influence. Their exports are more sought after, their contracts carry more weight, their geopolitical relevance rises. And this isn't just about oil. It extends to natural gas, refined petroleum products, and increasingly to emerging energy technologies. Liquefied natural gas, LNG, is a perfect example. As Europe and other regions seek alternatives to traditional supply routes, LNG exporters gain new leverage in shaping energy flows. But what makes this dynamic particularly interesting is that it's not just about supply, it's about perception. Because markets don't wait for actual disruptions to occur, they respond to the possibility of disruption. That means even the anticipation of conflict can reroute demand. And when demand shifts, so does power. What Ian Bremmer often emphasizes is that in geopolitical systems, influence is rarely absolute. It is conditional. It depends on context. It depends on timing, and most importantly, it depends on the structure of the system itself. In a stable world, energy flows are largely determined by price and efficiency, but in a world marked by conflict and uncertainty, those same flows are influenced by risk. And risk changes behavior. Countries begin to diversify their energy sources, not just for economic reasons, but for strategic ones. Long-term contracts are renegotiated, new partnerships are formed, old dependencies are reassessed. And in that process, some producers gain access to markets they previously struggled to reach. This is where opportunity emerges, because not all energy producers are equally positioned. Those with stable political systems, strong infrastructure, and the ability to scale production quickly are often the ones who benefit most from these shifts. They can respond to increased demand. They can expand output, and they can offer what the market is seeking most during times of instability, predictability. But there is another layer to this dynamic that is often overlooked. Energy markets are not just physical, they are financial. And financial markets amplify the effects of geopolitical change. When tensions rise, traders adjust expectations. Futures prices move. Hedging strategies shift. Investment flows are redirected, and this financial activity reinforces the importance of reliable energy sources. Because in uncertain times, capital tends to concentrate in assets that are perceived as stable. This creates a feedback loop. Instability increases demand for reliable energy. Reliable energy increases confidence in certain markets, and that confidence attracts more capital. So, energy producers who can position themselves as stable and dependable become not just suppliers, but destinations for investment. They become anchors in an otherwise volatile system. But this is not without its risks, because with increased demand comes increased scrutiny. Energy producers that gain influence must also manage expectations. They must navigate political relationships. They must maintain production capacity. And they must do all of this while operating within a global system that is itself under stress. So while they may appear as winners, they are also under pressure. This is an important point to understand. In a system as interconnected as global energy, there are no pure winners. There are only relative advantages, and those advantages can shift over time. What looks like strength today may become vulnerability tomorrow, depending on how the system evolves. But in the context of war, the short-term dynamics are clear. Disruption creates opportunity. And those who are um, positioned to respond to that disruption, those who can provide stability when others cannot, often find themselves in a position of increased economic and geopolitical significance. And this is not about exploiting conflict. It is about responding to it. And that distinction matters because it reminds us that global systems are not static. They are adaptive. They respond to shocks. They redistribute influence. And they create new centers of gravity based on the needs of the moment. Energy producers who understand this dynamic and who can align themselves with the demand for stability are the ones who benefit. So not because they control the system, but because they can operate effectively within it. And in a world defined by uncertainty, that capability is one of the most valuable assets a country can have. So when we look at the hidden economic winners of war, energy producers are not just participants in the global system. They are a reflection of how that system responds to pressure and how, in times of crisis, the demand for stability can reshape the flow of power across the world. So, because in the end, energy is not just about who produces it. It's about who can be relied upon when the world becomes uncertain. And that reliability, that quiet, consistent presence is often where the real influence begins. When we look at financial markets during times of war, something counterintuitive often happens. And while one part of the world is experiencing destruction and uncertainty, another part, specifically in financial hubs, can experience a surge in capital, confidence, and even growth. This is the paradox of instability. It doesn't just create risk, it reallocates it. And in that reallocation, capital begins to move. Not randomly, but strategically. It seeks out places where it can be preserved, protected, and in some cases even grown despite global turmoil. These destinations are what we call safe havens. Now, what defines a safe haven is not just economic strength. It's trust. Trust in institutions, trust in governance, trust in legal systems, trust that contracts will be honored, that property rights will be respected, and that financial systems will remain stable even when the rest of the world is not. And when conflict intensifies, especially in geopolitically sensitive regions, this trust becomes more valuable than ever because capital at its core is deeply psychological. It doesn't just respond to numbers. It responds to narratives, to expectations, to perceived risk. So when uncertainty rises, whether due to war, sanctions, or geopolitical escalation, investors begin to reassess where their assets are safest. And in that reassessment, capital flows towards stability. This is where certain economies gain a hidden advantage. Countries with strong financial institutions, independent central banks, deep capital markets, and stable political systems often see an influx of investment during periods of global instability, not because they are immune to global shocks, but because they are perceived as better equipped to absorb them. The United States is a prime example of this dynamic. Despite being deeply involved in global geopolitics, its financial markets often serve as a global anchor during times of crisis. The US dollar in particular tends to strengthen when uncertainty rises, not because the US is unaffected by global instability, but because it remains one of the most trusted stores of value in the global system. And this trust has powerful consequences. When capital flows into safe havens, it drives up asset prices, stocks, bonds, real estate. It lowers borrowing costs. It increases liquidity. And it strengthens the overall financial position of those economies. At the same time, it can place pressure on emerging markets or regions closer to the conflict, because as capital moves away from risk, it can create liquidity shortages elsewhere. Interest rates may rise, currencies may weaken, and access to financing can become more difficult. This creates a divergence, a global financial system where some regions benefit from increased capital inflows while others experience tightening conditions. And this divergence is not accidental. It is structural. It reflects how global markets interpret and respond to risk. What Ian Bremmer often highlights is that in a fragmented geopolitical environment, capital doesn't just seek returns, it seeks safety. And that shift in priority changes the entire behavior of financial systems. Because in stable times, investors are often willing to take on more risk in pursuit of higher returns. But in uncertain times, that equation changes. Preservation becomes more important than growth. Security becomes more important than yield. And stability becomes the defining factor in investment decisions. This is where the concept of safe haven assets becomes critical. Assets like government bonds from stable economies, gold, and certain reserve currencies tend to perform well during periods of uncertainty, not because they are the most profitable in all conditions, but because they are perceived as the least risky when the system is under stress. And that perception is powerful because it drives behavior at scale. Institutional investors, sovereign wealth funds, corporations, they all respond to these signals. And when they move capital, they move it in large volumes. This is why financial markets can react so quickly to geopolitical events. It's not just about what is happening, it's about what might happen. And that anticipation shapes decision making. Now, here's where the psychological dimension becomes even more interesting. In times of war or conflict, uncertainty increases, but uncertainty does not affect everyone equally. For some actors, it creates fear. For others, it creates opportunity because volatility can be profitable if you know how to navigate it. Traders, hedge funds, and financial institutions often adjust their strategies to take advantage of price fluctuations. They hedge risk, they take positions based on anticipated movements, and in doing so, they can generate returns even in unstable environments. This doesn't mean they benefit from conflict, but it does mean that the financial system has built-in mechanisms that allow for adaptation, even in the face of global disruption, right? And this adaptability is part of what keeps the system functioning. Because without it, uncertainty could lead to paralysis. Instead, we see movement. Capital continues to flow. Markets continue to operate, and despite the volatility, the system finds ways to maintain a degree of balance. But that balance is delicate, and it depends on confidence. Confidence in institutions, confidence in leadership, confidence that even in times of crisis, the system will hold. When that confidence weakens, the flow of capital can become more erratic, markets can become more volatile, and financial stability can come under pressure. So in many ways, the hidden winners in this environment are not just those who gain capital, they are those who inspire confidence, because confidence attracts capital, and capital in turn reinforces confidence. This creates a reinforcing cycle that strengthens certain economies while exposing others to greater risk. And in the context of war, this cycle becomes even more pronounced, because global uncertainty amplifies the importance of trust, and trust, once established, becomes one of the most valuable assets in the financial system. So when we talk about the hidden economic winners of war, we are not just talking about who gains in the short term. We are talking about who the system turns to when uncertainty rises, who it trusts, who it supports, and who it rewards with capital in moments when capital itself is most cautious. Because in the end, in a world defined by risk, the places that offer stability become not just destinations for investment, they become anchors in an otherwise unstable world. And those anchors don't just hold capital, they hold the system together. When we talk about hidden economic winners in a war-driven environment, it's tempting to focus only on the visible players, energy exporters, defense contractors, or financial hubs. But there is another category that often goes underexamined and yet may have the most long-term influence on the global order, the architects of energy transition and strategic adaptation. Because war doesn't just disrupt economies, it accelerates decisions that might otherwise take decades. In stable times, energy policy evolves slowly, governments deliberate. Corporations invest cautiously, infrastructure changes over long timelines. But in times of crisis, the calculus changes. The urgency to secure energy supplies, stabilize prices, and reduce dependency on volatile regions forces decisions that would normally face political resistance. And that's where opportunity emerges. We're already seeing this dynamic play out across the globe. Countries that were once heavily reliant on imported oil and gas are now aggressively investing in renewable energy, nuclear power, and diversified supply chains. Not purely out of environmental concern, but out of necessity. Because energy security and national security are now deeply intertwined, this is a critical shift in thinking. For decades, energy policy was often framed around efficiency and cost. Today, it is increasingly framed around resilience, the ability to withstand shocks, to absorb disruption, to maintain stability even when global supply chains are under stress. And in this new paradigm, those who can deliver resilient energy solutions become strategic winners. Companies and nations that invest in renewable infrastructure, solar, wind, hydrogen, are not just participating in an environmental transition. They are positioning themselves as essential players in a future where energy independence is a geopolitical asset. Similarly, advancements in energy storage, grid resilience, and localized production are becoming increasingly valuable, because the less a country depends on external sources for its energy, the more control it has over its economic and political future. This is where the psychological dimension of energy markets becomes particularly important. Energy is not just a commodity. It is a source of power, both literally and strategically. And in times of war, the desire for control becomes amplified. Governments begin to ask, where does our energy come from? How vulnerable are our supply chains? What happens if access is disrupted? These questions drive policy, and policy drives investment. So, while conflict may disrupt traditional energy markets, it simultaneously creates incentives for innovation and diversification. But there's a deeper layer here, one that often goes unnoticed, because the energy transition is not just about technology, it's about trust. Trust that new systems will be reliable, trust that renewable sources can meet demand, trust that investments in new infrastructure will deliver long-term stability. Without that trust, even the most advanced technologies struggle to scale. But when trust is established, capital flows rapidly. And when capital flows, transformation accelerates. This is why some of the biggest beneficiaries of global instability are not necessarily the countries with the most oil or gas reserves, but those that can anticipate the future and invest accordingly. Countries like those in Northern Europe, for example, have been early adopters of renewable energy, not just for environmental reasons, but as a strategic hedge against external shocks. By reducing their reliance on imported fossil fuels, they increase their resilience in a volatile world. And resilience in this context becomes a form of power, because it allows a nation to absorb disruption without collapsing, to adapt without losing momentum, to maintain stability while others struggle. This is the new competitive advantage. Not just access to resources, but the ability to adapt to changing conditions faster than others. And that applies not only to countries, but to corporations as well. Companies that recognize the geopolitical dimension of energy, those that diversify their supply chains, invest in sustainable technologies, and anticipate regulatory shifts, position themselves not just to survive, but to lead. Because in an environment defined by uncertainty, adaptability becomes the ultimate asset. And this brings us to a broader philosophical point. For much of modern history, economic growth has been driven by the assumption of stability, the idea that systems will remain predictable, that risks can be managed, and that long-term planning is possible. But the world we are entering is different. It is more fragmented, more volatile, more interconnected. And in this environment, stability is no longer guaranteed. It must be created deliberately, strategically, and often collaboratively. This means that the winners in this new energy landscape will not just be those who control resources, but those who can coordinate systems, those who can align governments, industries, and technologies toward shared goals. Because the future of energy is not just about supply, it's about integration. Integration of old systems with new ones, integration of national interests with global realities, integration of short-term needs with long-term sustainability. And those who can navigate that complexity will define the next era of economic power. But there is also a caution here, because rapid transitions driven by crisis can create unintended consequences. Supply shortages, price volatility, political backlash, uneven access to energy resources. So the challenge is not just to move quickly, but to move wisely, to balance urgency with foresight, to pursue innovation without sacrificing stability, and to ensure that the benefits of this transition are distributed in a way that strengthens rather than fragments the global system. Because ultimately, energy is not just about power, it is about balance. Balance between supply and demand, between risk and security, between national interests and global cooperation. And in times of war, that balance is tested, but it is also redefined. And in that redefinition lies opportunity for those who can see it, for those who can act on it. And for those who understand that in a world shaped by uncertainty, the greatest advantage is not control, but the ability to adapt faster, think deeper, and build systems that endure beyond the crisis itself. Because in the end, the future of energy is not just about who produces it, it's about who is prepared to evolve with it.